All right, so today we're going to talk about something a little bit different. As you can see, the stock market's kind of been a little bit of a turmoil. It's been correcting and things like that. And you've probably seen it on the articles that people are rushing into the treasury bonds, okay? They're fearing that a recession is on the way. Um, and as I always say in all my videos, I am not a fortune teller, nor do I claim to be. But I do want to share what I'm doing, and for my own archives, this is not like financial advisory. It's your money. You do your own research and figure out what you want to do with your money. I'm just presenting what I'm doing with mine, and maybe perhaps some of the reasoning behind it. So I don't know if you can remember this, but last year, I don't remember if it's October, December, or when it was, but well, I know it was before December, that everybody was scared that the Federal Reserve was going to increase interest rates. Well, I had decided in my brain, I said, you know what, they keep telling everybody they're going to increase these interest rates. I just don't believe it. They're not going to do that. So what I did was, after all this kind of occurred, as I'm a bit of a contrarian, I said, you know what, I'm going to buy long-term Treasury bonds because those are the ones that are most susceptible to interest rates. So, people kept saying it's a bad time to buy these things. Well, as you can see on the screen here, on November the 7th, that's when I first bought my first batch. This was for $1,000. And that batch is now up over 14%. Now, we're talking about bonds here. We're not talking about equities. So 14%. Too bad I didn't buy like $10,000 worth, right? So what you can kind of see here, if you look and see when it says cost basis zero, those are just dividend or distributions. And I want to talk about that. So one of the reasons I like bond funds myself, other than just protecting against a market correction or crash, whatever, is that bond funds, some of these are set up to where at the end of I think it's on the 31st or the 30th, you can see here that it pays a distribution. And, it doesn't seem like much. It's $2, $3, $4. But this is just, every month. And as this climbs higher and higher, these distributions are going to get higher and higher. So, now I'm up to $5.30, cents. So you times this by how many ever years, and eventually this becomes quite a bit of money, actually. I probably will end up having, I don't know, my goal in this is maybe $5,000 or something if the market keeps going down. But I just kind of wanted to share that, they say that market timing isn't so much as time in the market, but this shows you that timing the market can actually be a great thing, because if I had bought it, say now, well, the batch that I bought on May the 23rd, as you can see here, is only up 1%. So not doing that great. My savings account is going to do better than that thing. But anyway, so let me just talk about Treasury bonds for just a minute. So if you look at the 10-year Treasury bond, which is this guy here, I said that I bought on November the 7th. And as you can see, doggone, if I almost didn't time this perfect, that the 8th, I think it was the 8th, it would have been the peak. So man, I'm pretty good with my timing, not to brag, but I bought it right there, and that's when the yield is the highest. So that means that the price is the lowest, and then as you can see, it's dropping. So as the yield is dropping, my price has been going up. So I timed this really good. And this, of course, was the correction in December there. And so, needless to say, it was a smart move on my behalf. And that bond yield has been dropping like flies here the last couple of days. And people are starting to worry, They keep talking about the inverted yield curve, and I won't get into that right now. As a prediction of a recession, maybe sometime in the next 18 months. But for now, I'm just going to present this. So yeah, as you can, keep your eye on the 10-year. It tells you a lot of stuff. It tells you how's the market going. And right now, we are at 2.23, which is the lowest it's been since, let's see, what is this? Over here, 2017. Okay. If we look back on our history, what if the bond yield gets way down here again? My bond fund is seriously going to go up in value if we get down to here. So this is something that's negatively correlated with the market. So if the market's going up, this may be going down, and vice versa. This is the long end of the yield curve. So this is determined more by people's economic outlooks. But I'm just going to throw this at you. We have a serious problem here in Japan and Europe. their bonds and their rates are negative. So for us, if the bond is paying out, let's go down here to the worst one, like 1.4 or something. That sounds awful. We can get more money in our checking account. But if the guy that's getting negative yield, meaning that he's having to pay the banks to hold his money, he thinks 1.5 is fantastic. So you actually have a bunch of foreign investors, that are buying up 10-year Treasury bonds because it's better than what they have in their own country right now. So I kind of expect this to continue. I don't know. I don't have a good feeling about this. I think that we're gonna crack 2. I think it's gonna go below 2. I don't know if it's gonna go to 1.5, God forbid, but 2. And I expect that my bond fund will just keep giving me money and more money, which I like a lot. So what I was going to say is the particular bond fund that I have is ticker FNBGX. This is the Fidelity Long-Term Treasury Bond, and wow, this thing is great. Even when the yield goes up sometimes, this thing still goes up. So sometimes paying a manager is better than just having an ETF, and I'll get into that in just a minute. But you can kind of see that I don't have a ton of money in there. I think I have $2,400. I'm going to put more in there, but you can see that I've kind of just reinvested over time. Here's another 150, 100, 400, and the other day I said, you know what, here's 500, put an extra $500 in this thing, and see what happens. Bonds are less volatile than the stock market, so I feel like if something starts happening, if some crazy occurrence comes out and they say, hey, we're going to raise the interest rates, I have time to get out of this thing. It's not like the stock market where they say something and the thing falls 30% just immediately. So I feel pretty good about this. If you want to get an ETF, and I actually have the ETF too. This is in my, I have an old rollover from an old company I used to work for, and this is in my retirement account. But I also have this in my brokerage account under the ETF TLF, which is iShares 20-year Treasury bond. And as you can see, if you had bought this, what is it, November the 7th or something, when I said I bought it, if you bought, look at this, it would be great. You just go up, boom, boom. I haven't owned it for long, but I put it in my brokerage account. Now, the only thing bad about this is you do have to pay some taxes on it, but you know what? The market's not doing that great right now, at least parts of it. So it's just insurance policy as far as I'm concerned. I'll take it. As long as it yields me over 3%, I'll take it. It's fine. Speaking of bonds, I also have this bond. I've kind of been on a bond buying frenzy this year, risk management, so to speak. I have my individual stocks, but I also have my bonds here. Anyways, I have the Fidelity Sustainability Bond Index. That's ticker FNDSX. This is more of an intermediate term, so it's less susceptible to interest rates. For some reason, it was down today. I don't know why, but it was down 0.10%. But as you can see, I'm up 3.03% in that. I've owned this since December the 20th. My credit union savings account pays 2.5%, so this is a little more than that. It's just a good place to kind of park some money, get a little bit of interest off of it. And once again, it pays a distribution on the 31st. And what was I going to say? Yeah, so this one is not going to go up and down as much. It's less volatile. But I have just been putting in a little bit here and there, 600, 150, 125. And you can see here that I've been getting these distributions. But if you count from when I bought it in December the 20th, that batch is up 3.21%. And yeah, I have just a little bit in this account. I think I have $1,100. Some people don't want to show their accounts, but I have anything to hide here. I wish I had more money in these things. I have a regular Roth IRA, and it is a lot less complicated than this account, but this one is more I'm playing around with different scenarios and things. But I urge you to get into bonds. I mean, why not? It's risk management. I just bought some municipal bond funds and a closed-end municipal bond fund, so I'm buying bonds right now. I haven't been buying any stocks. I can't remember the last stock that I bought. It's weeks ago. Some of my stocks have been getting hammered. I like to present the truth on this channel. I like to just tell people, this is going good. This is not going good. But my bond funds are doing great. They're bringing me an extra money in, just a little bit here and there. Stocks, I have, American Eagle's probably the worst one right now. It's just been getting clobbered. I think I was up 25% and now I'm down. But you know what? I'm not selling. I don't care. Let the thing fall. Let it fall 50%. I don't care. I'm just going to hold. It's going to be there for a while, and I'm not worried about it. General Mills had kind of a rough day today. The Goldman Sachs, they downgraded it for basically no apparent reason, so it's down 6%, but I'm still up over 25% in that, so I don't care about that. I'm going to literally, if the recession comes tomorrow, I'm just going to keep I'm going to keep General Mills in my portfolio, and I'm going to ride out the dividend. I don't care. Um, Probably the worst performing stock that I have right now is Snyder Trucking. When I bought it, I knew it wasn't going to be like a great performer. You know, I was just kind of a play on the transportation sector. It was down at near the 52-week lows, but it's been getting hammered. Luckily, I don't have too much money in it, so it doesn't matter too much. But I'm going to literally just ride it out. Like I said, if the recession comes tomorrow, I'm just going to ride it out. I don't care. If even it pays like a little bit of a dividend, it's not much of anything. It's like 1.2%, but you know, I have all the time in the world. This is not short-term mining here. So I'm just going to let it ride. But I do say, start turning your attention to the bond market. You should have already started turning your attention there maybe months ago, but it's never too late. I think that we have some room to fall here. I don't think we're done. I really don't. I wish the economy was in better shape, but I strongly feel like it's not. And here's why. You can see that there's a lot of interest in the 10-year, and that's not a good sign. Okay, and then also, I just got through telling you I own trucking stock. Transportation sector has been doing awful. It's been getting hammered. I'm talking about FedEx, I'm talking about UPS, I'm talking about JB Hunt, your railroads, all the stuff that measures all the goods that are coming in and out of the country. That stuff has been getting clobbered. So I don't believe this, growing GDP stuff. I think that, things are not bad. We have, quote, lower unemployment and things like that. I think things are awful yet, but I think it's a sign of things to come. I think the transportation sector is telling us something, and then this is telling us something. So we need to be paying attention. And if you ask my advice, I would say don't buy stocks right now. Wait for the thing to correct and go in then, after we have a correction. Right now, I wouldn't say to sell either, though. I think it's bad to just sell just because it's falling down. I know sometimes it's hard to look at your portfolio and it says minus 14. Let's be honest here. Everybody has one of those. Hopefully it's not just me. No, it's not. You have a minus 14. Just give it time. It'll come back. If it's 2 years from now, and if we have to ride the recession out, it's 2 years. Hopefully you're not putting money in this thing that you need immediately, but just ride it out and go from there. All right. Take care.